Good. What's going on, guys? How are you? How are you doing? This is Shocks, and this is ShocksCapital YouTube channel. Does demand and supply work on synthetics? This is the question most of you have been asking me, and today I want to address it. I want to show you how you use demand and supply on synthetics. And the synthetics that you are using today are synthetics from WellTrade. If you don't have an account yet, what you just have to do is to go in the description down below, click that link, go to WellTrade, register your account, fund that account, and be sure to open a SynthX account. That is the account for synthetic indices. Don't open a pro or another account because you see currencies, but you can do that if you want to trade currencies. But if you don't want, go for a syntax account. After you get a syntax account, you can now trade synthetic indices on WellTrade. So today I want to show you this about demand and supply. So what is demand and supply? That's where we start. Demand and supply is a concept where we are going to get our sell position on an area that we deem supply and an area that we think is a lot of suppliers or a lot of sellers ready to sell, or a lot of sell orders. And demand is the opposite, where we are thinking that, or we are predicting that this area is a lot of buyers. So how do you do that? You do that using price action. When price is falling down like this, when price is going down, okay, let me use a better tool. When price is going down, right, what you need to do is, let's say price is going down like this, right, and it gets to a point where it's dragged like this and it continues going up. What this means is, when price is going up, sellers are in action. When it gets to a point where it drags out and it forms kind of a pause, it means that buyers have entered the market, or there are a lot of buyers there, which kind of drag or delays the movement of price, and sellers will get in again and continue. It means that this area that price would have paused is a lot of what? A lot of is a lot of what? Is a lot of uh sellers or buyers that are going opposite to what has been happening in the market. So let's say sellers are in the market, then sellers win at this particular point. It means that at this particular point, yes, there were buyers, but there were more sellers to buyers. That's why price continued going down. If we had more buyers in this area, price would have what? It would have gone up. But since price did not go up and price went down, it means we have more sellers than buyers in this what? In this area where price paused. What does that mean? That means that when price comes back to this area, these sellers that we had here are still there and the buyers are still there, and we are still thinking that since we have more sellers in that area, price should go what? Should go down. Same applies when price is going up here and it gets to a point where it drags out. It means we have met some sellers here and there's some resistance in this area. But what would have happened eventually is the buyers in this area overpowered the sellers. Hence, price would continue going up. So when price is retracing back to this what? To this area, it means that when price gets to this area right there, it means price is retraced back to a what? To an area with more buyers, to more to less with more buyers compared to what? To sellers, right? Which means that price is projected to what? To go up again because of the buyers that are in that area. With that thought, with that reasoning, let's go back to what? To our MT5, and we are going to be looking at the FX volatility 80, which is on the H1, and the WellTrade broker. So remember, if you want to trade with WellTrade, the links are in the description down below. You can find the links and you can go straight to your what? To your registration portal and you get your account. So what is happening in this area is simple. Price is going up, then it gets to a point where it drags out, right? Which means this area is sellers, but the sellers were overpowered by the what? By the buyers. Which means that if we mark this area like this as our demand zone, what we are expecting when price comes back to that area is simple. We are expecting price to go up because in that area simply we have what? We have more buyers to sellers. That's why you see when price gets back to these zones, it what? It goes up, it goes up and goes up. And let's go and look in this area again. Remember, you have to see an aggressive move first a pause, and another aggressive move in any direction, what you just have to do is to mark the demand zone that you think is the demand zone, or that I'm showing you here. After marking that, you check what happened after that demand zone had settled in. If price had gone down, it means that when price comes back, it has to go down, and vice versa. So we have this demand zone, right? That was as a result of this move down and a pause. So that pause is what we are terming as the demand zone. So just mark it as it is as a whole. Remember, these are not order blocks, and we are marking the demand zone as a zone, as a clutter of candlesticks, as you can see. So price goes down, right, but comes back and retests this demand zone and goes down again. So this is how we are looking at it, and this is how we are doing it. And if you go further, you will see that this phenomenon carries through and through as price moves. And this is how we want to be trading if you want to trade demand and supply. You see, there is a breakdown. After that, we have this pause in what? In price, right here. And this pause is what we are terming demand, and that pause is what determines what happens when price moves back to the what? To the yellow zone. And you see what is currently happening. And go here again, what do you see? You see a pause, a down market, a pause, and a down market. And when price comes back, it does exactly what we want it to do. So this is what price is currently doing. And from this same logic, we see that price goes down and pauses at this particular point. So what are you expecting as price comes back to the yellow zone? It's simple. You are expecting price to get back into the yellow zone and go. And remember, on this world trade, we have commodities that look like the demand, that look like the what? The boom and crash. And one of those is pain X 999, and that one is shown here. So I want to show you if this phenomenon also works on what? On commodities that look like, or that have the same behavior to the booming crashes you can see here. So if you go to the H1 or H1 here, what do you see in terms of demand and supply? So let's start here. What do you see? Price goes down at this particular zone, gives you this whole demand zone, and goes down. When price comes back, you see what happened. And this is the same when price is going down in this area, pauses and gives you this pause, this demand zone right here, and price traces back to that particular demand zone, and you see what happens to price. And even if you open another one, let's say FX volatility 40, as you can see, so these red ones are demand zones that we marked here, and we were expecting price to do something or to retrace at those particular zones. And as you can see, this is working on synthetic indices, and this is what you want to see if you are trading these indices with world trade. This is what I wanted to show you guys. If this is something that you're looking forward to, and if this is something that you think you can trade, and if this is something that you think you can make money with, make sure you open an account with world trade. The links are in the description down below. After opening an account, make sure you follow us on Telegram and follow our trades and signals. Shocks out. I'll see you in the next video. Bye bye.